For more on Senator Dodd and the Banking Committee's plans, we are joined now by Dean Baker. He is co-director of the Center for Economic and Policy Research. Mr. Baker, thank you for joining us. Does Senator Dodd's proposal have merit?
Well, there's a lot of interesting aspects of it. I have to say, I've not read it. It's over 1,000 pages. I've not read it at this point. But what I've heard about it, there are interesting aspects. The idea of having the the district Fed banks appointed by, in some manner, through Congress rather than banks. That's a very, I think, interesting and important proposal, because currently you have a situation where the Fed, essentially a bank regulator, is in large part the district bank president, at least appointed by the banks themselves. It's a very unusual situation. Senator Dodd's proposing to change that. He's proposing to have a single regulator. Again, in many ways, a radical departure. You know, we have the Office of Thrift Supervision, which oversees the savings and loans as separate entities from the banks. Basically, there's been no distinction between banks and savings and loans for a quarter century, but we still have a separate regulatory structure. So this would be a very big step to consolidate all the regulatory structure in a single regulator. Hard to see how that will be done. He's proposed getting rid of the too-big-to-fail institutions. How exactly he proposes doing that, I'm not sure. I'll have to see in the bill, but that, again, would be a huge departure if we were to insist that we break up a Citigroup, a J.P. Morgan, the other big banks. That'd be a very big departure from current practices.
What kind of reaction would you anticipate from the Fed and the FDIC right now on the heels of this Dodd proposal? Are they going to fight to retain their authority and autonomy?
That would be my expectation. I mean, every regulatory agency is very protective of its turf, and certainly the Fed and FDIC are no exceptions. Again, I think that would be a very big jump to imagine that somehow you'll get some sort of take away the supervisory authority of those two agencies. What will be, I think, most interesting, and perhaps I'm saying this because I think it's actually something that could happen, is whether you do get this move towards having Congress have more direct say in the structure of the Fed, taking that authority away from the banks, because a number of other people, I believe Representative Franken made the same statement that, you know, where else do we let an industry appoint its own regulators? So I think there's a very interesting proposal to come from Chairman Dodd, and it'll be interesting to see if that goes forward.
Mr. Baker, you just mentioned too big to fail. That's been part of the American lexicon for like the last year and a half, 2 years now. If the bill, as Senator Dodd suggests, will end too big to fail, does the problem then become defining too big to fail?
I don't think so. I mean, people make too much of this. The point is, we have institutions today that there's no doubt about. No one thinks that J.P. Morgan, if they got themselves in trouble, that we would let them go under because the impact on the economy would be too large. Now, can you have an institution that's at the margin that we can't say for sure? Yeah, that's certainly possible, but then you don't have the same problem. The idea is that I could lend money today. I could, you know, lend, I don't have $100 million, but if I had $100 million, I could lend that to J.P. Morgan, and it would be just like lending it to the U.S. government, because I know I'll get that back. On the other hand, if we take a smaller bank that it's possible the government wouldn't let them go under, but I don't know that, well, I have to be cautious about that.
Is there a possibility that however well-intended this proposal is, it could end up taking away necessary checks and balances in the system?
Well, there is something I value in having multiple regulators, because in principle, if you get one regulator, they could be asleep. You have the problem of regulatory capture. They're more, you know, concerned with what the banks want than what the public needs. So if you have at least a second, you know, regulatory agency, that decreases the likelihood of that happening. So I think that's a realistic concern, and it's a trade-off. I mean, there's a value in not having multiplicity of regulators. We had the regulatory shopping where banks, financial institutions picked the regulator that was most beneficial to them, so we get away from that. But on the other hand, you reduce this sort of possibility that one regulator will catch what the other one's missing.
Some of the particulars of the plan, this idea of setting aside hybrid debt securities in an account, so to speak, if more trouble arises, is that realistic, especially given the astronomical amount of toxic assets that, you know, led us to this crisis in the first place?
Well, again, I'll have to look at the details of it. I mean, if you're setting aside, in effect, this is a form of a increased capital requirement, which, you know, does make sense. But again, you sort of have to ask, well, if the idea here is we're getting rid of the too big to fail, then why are we also, you know, setting aside, you know, extra debt securities, whatever form this might take? Again, these are sort of alternatives, or at least they've generally been put as alternatives, that where we get large institutions, we're in effect going to penalize them by having higher capital requirements or some other, in effect, penalty for being so large. If our main target is to simply not have them be so large that, you know, they might require a taxpayer bailout, then there's less need for that.
Dean, if I'm not on Wall Street, if I'm sitting at my kitchen table somewhere in my living room right now, and I'm hearing this interview or watching Senator Dodd, my question is going to be, how is this going to affect me?
Well, there's several different aspects. First and foremost, I mean, we're sitting here with 10% unemployment, 10.2% unemployment, because our regulators messed up. And, you know, everyone should keep that in mind. This is an enormous disaster that could have been prevented with good regulation. Does the new regulatory structure ensure that this won't happen again? I sort of doubt it. I mean, I don't know any regulatory structure is going to be perfect that way, but that's a really big deal. Secondly, some other aspects of this. There's part of this that we're going to have a say on pay that will, in principle, limit executive compensation. Right. To my mind, we've had enormous rip-offs of basically the public, you know, because at the end of the day, we're all paying for these tens of millions of dollars salaries. That money comes from somewhere. Also, the Consumer Financial Products Protection Agency, we know that when we go to the bank, we get a credit card, we get a mortgage, we'll be able to understand it. We won't be ripped off. These are big things.
So bottom line, do you think Congress will complete work on financial system reform this year or next year?
Well, for sure not. I'd be very surprised if they did this year.
Right, it's the end of the year. I lost my calendar.
Yeah. So I don't expect this year. I think we will get something. What that looks like at the end of the day, really hard to say. But there'll be a premium on producing something just so they could say they accomplished something. Whether the final bill is something anyone's going to be proud of, I think is very much an open question at this point.
All right, Dean Baker, many thanks for your time and insights. And gosh, it's already the holidays. Can't believe it. Almost.
And Dean, thanks so much.